Hey friends, hope you're doing well. Today we're going to talk about ways that you can finance a growing real estate portfolio. And there are a few main ways. Now, what I'm not going to talk about today is this idea of seller finance and zero down and these types of things that you're hearing promoted. That's not that they don't exist. It's just today I'm going to focus on really leveraging other people's money. And what I mean by that is we're going to talk about the two main ways. There's actually three main ways you can finance a growing real estate empire. You can put your own money into deals. That's the easiest way to do it, but not everyone has that kind of discretionary income to invest in real estate. And I've been fortunate enough in my life to participate in working with real estate investing, both as someone who has funded those types of ventures. So working with real estate investors as they get loans, real estate investors as they get equity, and so meaning other investors. And I've also been on the other side as an investor in real estate myself, properties with the family, and then turning around and financing investors. So we're going to talk about leveraging both loans and investors for financing a growing real estate empire. Now, the biggest thing I want you to think about when it comes to that decision, whether you use loans or investors to finance your acquisitions, maybe it's a combination of both as you do more and more acquisitions. The biggest thing I want you to think about is that, remember, investors are future focused and lenders are historical focused, meaning lenders are going to give you money based on the things that you've already done. Investors are going to give you money based on the things that you say you're going to do and the possible return that they can get along the way. So let's talk about lenders to start. And before we talk about specific programs that are available to you, I want to reiterate this idea that lenders are historical focused. And what that means is they're looking for sources of repayment. The primary source of repayment is going to be cash flow that you can generate with these investment opportunities. The secondary source of repayment that they use is going to be the properties themselves. So if you are buying rental properties, the cash flow coming off that rental property will be considered the primary source of repayment. If for some reason you're not able to pay them, then they'll foreclose on the property. They'll take that, sell the property, and use those proceeds to pay themselves back. So just remember, you've got this idea of primary and secondary sources of repayment when it comes to lenders. So let's talk about a few sort of typical types of loans that you can look for. And the first one we're going to talk about is what you might call a conventional loan. And the way to think about this is if you're particularly in the US and you have a mortgage on your house, you may have a 15 or 30-year mortgage with a fixed rate that lasts for those 15 or 30 years. That would be a conventional mortgage. Now, in a lot of instances, a conventional loan is going to require that you put a substantial amount of money down on the investment property that you're buying. On average, you might be looking at about 20%. And the reason that number matters is because that will help you avoid paying for PMI, or basically mortgage insurance, on the loan itself. So a conventional loan is just what you're thinking about when you buy a house, investing that in investment property, 30-year loan, fixed rate across the board, probably going to have to put 20% down. There are programs, you're thinking to yourself, Jonathan, there are programs for conventional loans where I don't even have to put that much down. We're going to talk about some of those, but your typical conventional loan is going to require that you put about 20% down. Then there are FHA loans, which are Federal Housing Administration loans, and you can use these to buy investment properties all the way up to 1 to 4 units. So you could use this to buy a duplex, so two units in the same structure. You can use FHA loans for those types of things. FHA loans are great for borrowers who cannot meet the requirements of a conventional loan. And what that tends to lean toward is borrowers who have a little bit lower credit scores than you might get through a conventional loan. Now, why would you get an FHA loan versus a conventional loan? Again, if you have a lower credit score, FHA loans typically have a higher total cost of borrowing, and they've got some restrictions as it relates to the investment properties you may buy itself. So FHA loan might be great if you've got some challenges with your credit. But a conventional loan is going to have less restrictions and probably a lower total cost of borrowing. Think about a lower APR, annual percentage rate, that you're paying between your rate and your fees. So FHA loan, not bad if you've got a lower credit score than typical, but going to have some additional restrictions you're going to have to struggle through. Then there are veteran affair loans that you can get. And yes, you can use these for investment properties. These are specific, as it sounds like, for a military veteran. You can qualify. One of the great things about veteran affair loans is that they take zero down payment, and you do not have that mortgage insurance that I was pointing to earlier. So mortgage insurance is going to be as a percentage of the loan balance, and it's going to increase your monthly payment that you're going to have. Another way using a loan to finance a real estate investment portfolio is to use a home equity loan. So maybe you've got a primary residence, you've got a lot of equity, meaning the difference between what you owe and what it's worth. You've got a lot of equity available to you. You can use your primary residence as that collateral, that secondary source of repayment we talked about, and you can pull out some of that equity through a home equity loan to invest in rental properties. So one of the great things about doing that is that you can go ahead and set that loan up, that home equity loan. It's usually a variable loan, meaning it's like a line of credit. You can draw however much you need. Let's say you have been approved for $100,000, but you only need 50 to put into the rental home. You can borrow that 50. You only make payments on the $50,000, and you still have 50 available to you. So you can use that to buy a second property, or even third if it doesn't take the whole amount. So home equity loans are nice because you can have that set up ahead of time, and that allow you to sort of turn it into really quick cash to buy the property with. Now, one of the other things I want you to think about when I talk about lines of credit is this idea of what's called a guidance line of credit. It's very similar to a home equity loan, but it's essentially getting that pre-approval for, let's call it $100,000 that the lender is willing to give you to invest in real estate property. And what they do is they pre-approve you, and they say, as long as the properties that you buy under this guidance line of credit meet our specifications, then we'll go ahead and approve it. So they approve you for $100,000, and then you find a property you want to buy, and you're going to have to spend $50,000 to get into that property. You would then take the $100,000. They take that $50,000 piece, they peel it off into a separate loan that's $50,000, and that means you have $50,000 you can still use under your guidance line. And then you find another property you want to buy, and it's going to take $25,000. You peel that one off into a second loan. Now you have a $50,000 loan over here and a $25,000 loan, and you still have $25,000 available over here. And you find your third property that you're going to buy, and you peel it off, and now you have 3 loans, and you've used up your entire guidance line. Guidance lines, not every lender does them. Typically, more commercial banks do them. They're familiar with the concept. This pre-approval allows you to, when you find a property you want to move on quickly, to really, really snatch it up really quick. So there's kind of a quick shot at how you can use loans to finance a real estate empire and portfolio. You're working with lenders. You're going to be making regular payments to them. They're going to be looking for sources of repayment, which is the cash flow coming off the properties, probably cash flow that you already have. Maybe you've got a day job and you don't have a ton of debt. That's cash flow that they can see that will be available to make the payments. If maybe the properties aren't rented, then the secondary source of repayment being the collateral of the real estate itself. Now, that's the lending side. Now, you can finance a real estate empire by using other people's money, by taking on outside investors. So I've worked with a lady named Anita in Texas, and we designed some of her documentation to attract these lenders. And I'm going to talk about that process here. So attracting real estate investors is very similar to being a startup that's attracting investors and giving up equity in the deal. And that's exactly what you would do. So if you want to use investors instead of loans for various reasons, you can attract them. Maybe you get, call it that same $100,000 from investors, and you can use that to invest in real estate properties. And what you are doing is managing that process. You're identifying the properties, you're making the purchase, you're finding the renters, you're dealing with the renters, you're doing any renovations. And the real estate investor is basically a passive partner that, in exchange for the money they give you, has an equity in that business and likely will get some cash flow off of it. And the reason I'm touching on this is I want you to think about what investors are looking for. So just like a lender, they want to get a return, but investors are typically going to be looking for a much higher ROI or return on investment than say a lender would. In a lender, you may get 5, 6, 7, 8% loan. An investor's probably looking for somewhere north of 10%, if not even higher. So investors are looking for a nice, strong ROI. And one of the key points with this is they want one that is better than they can go get elsewhere. I want to say that again. An investor's looking for an ROI that is better than they can go get elsewhere. So let's say they know that in the stock market, they can average 5 to 7% return. If the return that you're demonstrating in your investment properties is around that, then why would they do that deal? Why wouldn't they just keep doing what they're doing? If for some crazy reason in a savings account, they can get 5%, why would they put money with you to get a 5% return unless they're wanting to diversify? So they want an ROI that is comparable or better than other investment opportunities of a similar risk profile. That's one of the key things I want you to think about. Something else that investors are going to be looking for that you need to be mindful of is security and stability, right? So real estate investors and a lot of people see real estate as fairly secure and stable. Certainly we've had fluctuations in values, but for a while, real estate properties have been going up and up. And it's not just the cash flow that you get off the rental or the flip that an investor gets to take advantage of, but if you keep the property, they get to take advantage of appreciation and tax write-offs and all these things. So real estate kind of has this stability. They could be putting money in cryptocurrencies and those were down, I don't know, 10 to 17% sometime last week. So that really hurt. So they're looking for some sort of security and stability by investing in real estate. And as I alluded to a minute ago, they're also looking for some diversification. One of the key things is someone raising money from investors is that they're looking for someone with experience. So if it's your first time putting together a fund that is you're gonna pull together funds and invest in real estate on behalf of investors, it's going to be a hard process because you won't have a whole lot of experience in this thing. Maybe you can offset that by sharing that you have invested in your own rental properties and now you're just wanting to scale the investments that you do by taking on investor money. That will help you. Maybe like Anita, you had successful projects in the past and you can demonstrate that those occurred, that you took on investor money, you got them a nice return, et cetera, et cetera. And that will improve your chances of getting investors for a real estate portfolio. Now, one of the last things I want you to think about is what you're going to need to approach investors. And I recommend that you treat real estate investors just like you would a startup investor. And that means having the right documentation that you're going to need to use, which is what I did with Anita. She hired me and my team to develop her documentation, pitch deck, projections, this type of stuff. And you can actually check out a testimonial on one of my websites. And she was able to raise over $1 million in a few short weeks by working with me and the team. And so I recommend preparing a typical pitch deck and projections to share with your investors, to show them what you're doing, to show them your experience, to show them the types of properties you're looking at, and then show them the projections of what you think that you can help them earn as an ROI. Create these documents for them. And then two last things to consider. If you're going to be bringing on investors to grow this real estate portfolio, you're going to have to think about incorporating in some way a single member LLC or a sole proprietorship. That's not going to cut it when you're taking on investors. Using loans, you could do that. You could have a business that's a single member LLC or even a sole proprietorship doing business under your social. But if you're taking on investors, that's not going to work. You're going to have to incorporate in some way. So I do recommend you talk to an accountant and an attorney. Typically, I see folks have a LLC or a full C Corp when they're doing these types of things. And then the last thing you need to consider, and this would be depending on where you live and what your attorney has to say, is you may need to consider putting together a private placement memorandum, which would be called acronym would be PPM. This is basically a larger document. Think of when you're investing in a stock, they'll send you a prospectus which details the stock and its performance and who runs it and all these types of things. That's kind of what a PPM will do for you. In general, and this is not a legal opinion, but in general, if you're raising money from a select or small number of accredited investors for your fundraising, you probably don't have to have a PPM, but I still recommend raising money to invest in real estate, treat it just like a startup. Go ahead and prepare a pitch deck and projections. There's other documentation that Anita had to prepare to send to these investors. There were surveys and plot maps and all this other stuff. We really worked with her on the investor ready documents like the pitch deck and the projections. So real estate's a great place to be. I really like it. It brings a lot of benefits. Again, just besides the cash flow, you're getting tax benefits in many instances. You're getting appreciation if things are going well. You're having someone pay down. If you've got a loan, you're having someone pay down that note on your behalf, basically, if you price it appropriately. So real estate can be a great investment. If you're looking to establish yourself or maybe even grow a real estate portfolio, there's these paths that are available for you. The biggest thing is to understand lending versus investors, what each one is looking for, what it's going to cost you to do this type of thing, and then knowing what those types of folks look for. Investors are looking for a little bit different things than lenders are. But I recommend thinking these things through as a way to finance a growing real estate portfolio, and then as a way for yourself to grow some wealth along the way. Anyways, glad to be back with you. And until next time, hope that helps. Hope you find your voice. Have a great day.